So once that's ready, yeah, awesome. Let's go ahead and start with the Prime Minister's speech.
Great. Give me 1 second to set up my screen and I am ready to go. Starting. Look, it's important to understand who owns these algorithms or who's prone to own them in the future. It's generally stock trading companies like eToro, Tradeville, Revolut. They're slowly, because they already offered products and services that enable individuals to access the stock market. It's their interest to adopt these AI trading models in order to enhance the services and enhance the power and the potential value that their customers gets them out of them. They do a slow implementation of these algorithms and they over test them and test them because they have such a high impact over the value and the risk that their products have. But let's talk a bit about what their products do. Their unique selling proposition is to actually enable individuals who previously didn't have the know-how, the ability, and the access to the market to trade stocks, to give them a tool that enables them to join the stock trading market and be competitive with all of those large companies that are doing stock market investment, and also replace little traders, which in the 90s and the 2000s were like doing cold calls and were tricking people into investing into random unreliable stuff. The thing that they are aware of in most of the cases is that they play with a lot of risk and they are aware of what that risk can do for their product. If a lot of people lose their money through their system, people abandon those platforms because they do not deliver honestly the value they are promising to individuals. Therefore, it's their incentive to have a slow adoption, to promote the use of small sums of money while you educate yourself, and to actually have programs have self-education. For example, Revolut, before you can actually trade to their platforms, you need to finish modules of stock trading where you start to understand slowly what is your the risk you are being exposed. What we are saying is that because of competition, because of between of those platforms, and because of regulation, because most of these companies exist in EU and US, there's probably going to be no winning algorithm that is better than everything, right? This is like there's no race to the top, and there's going to be one single thing that takes the future. Then the second thing is, where do the money come from on this platform? And look, these are market traders. It's not investment funds or hugely rich individuals. Usually these have huge like offices with their own internal tools and risk assessment. And usually their strategy is long-term rather than short-term. So regardless of how the market behaves in a short-term period, they are usually generating a strategy when they are building a portfolio which spans over years or even dozens of years and sometimes. So they are not really, their fluctuations in the market are not so relevant for them. So these tools are not necessarily catering for them. They're also not short sellers. It's usually people, individuals with relatively small net worth. Let's think about lower than $300,000 net worth, who want to save some money and generate some passive income, genuinely your average employee. So then our case moving forward is going to answer to the following question. Why are Diana from Bucharast and Joe from Alabama the worst actors to actually conduct this investment process through these platforms, and why do we believe that their ability should be delegated to these tools and they should delegate a lot of the choice to these tools? We believe that they are the worst actors to make choices in terms of what stock should I choose when I have $100 or $1,000 to invest, because they are predictably irrational. They have a short-term mentality. They have a hard time, as behavioral economics have proven, they have a hard time to assess the impact of financial pain. So whenever they are losing money, they are overreacting to that. There's a herd mentality where a large shark withdraws from that system. So that makes them sell quite fast because of the fear. Because the second mechanism here is there's a symmetry of information. Most likely these individuals, in the best case scenario, they get their information from a YouTube bro, because generally speaking, that is the closest system that can educate them, right? On top of that, let's say you have the Revolut module, but that is the best case scenario. On the other side of the spectrum, on the same market, you have the huge offices that are supplied by, I don't know, Morgan & Stanley or whoever does market investments, which have a lot more understanding of trends, company budgets, assessments, and so on and so forth, like the financial health of a company, projections, understanding how projections works, and so on and so forth. Thirdly, they are incapable, not only to understand how the markets work now, but incapable to understand oftentimes what is the next big thing. So they have an easy time to buy into the idea that, look, this Neo company from China is the next EV company that is going to revolutionize the electric car system. And then what turns out, that is not going to happen. Another example here is Virgin Galactic with Richard Branson, who did a marketing stunt, invested a lot of money, pulled a lot of people's money into his company, and then withdraw first, and then a lot of people withdraw his money. He got a lot of money out of it, and then the company never succeeded to properly conquer space, never deliver value, never allowed people to win a lot of money. They can be easily tricked. So what the final statement here is, in order to give people access to a market, the first thing and foremost is that they should have the ability to play on that market, and the tools give them the ability to play on that market. And that's the first point that legitimizes the market itself. If that market does not offer you the tools, you should not be able to access it. These tools offer the legitimacy. CEO, I'm going to accept the POI.
D.E. Shaw, Terra Sigma, Renaissance Technologies. These are all massive hedge funds that use these kinds of technology in the vast majority of instances. Clearly, this debate is not about individuals because it's very expensive to train an AI model on either side of the house.
Look, it's not going to make a big difference for an office with 40, 50 employees. They are going to have a lot of asymmetry of power anyway. What we are doing, and this is where I'm getting into my last point, we are improving the risk management. Now you can compete with those 30 people because you have an algorithm that can do the same thing. Instead of being alone, and by the way, market democratization of these tools already exists. You're alone on your phone and you see at the TV that Richard Branson withdraw from Virgin Galactic, you are going to instantly sell as well. And a lot of people are going to do that as well. What we are enabling individual is to now be competitive with these large offices, and the knowledge delta and ability delta lowers down. They are now better at risk assessing because it's not them who does the risk assessment, it's the tool. That means that they are less likely to be tricked, and they are less likely to engage into short selling, therefore diminishing their wealth in the advantage of other people. For all of this reason, I beg you to propose.
Fantastic. Leader up.
Hello, am I audible?
Yeah.
Awesome. A very simple case from opening opposition. First, this turbo fucks the allocative efficiency of the market by rewarding worse businesses with capital with huge societal implications. And secondly, this causes much volatility in the market, which has deleterious impacts on people who rely on the benefits of trading on the stock market. But two erroneous things before I get on to that case to deal with that Prime Minister's speech. Firstly, on the idea that algorithms compete with one another, so there isn't a dominant algorithm. The first, I guess, three observations. First, it doesn't really matter if that's true because they're making predictions about the same fundamental market data, which means the predictions that they're going to make are relatively because the underlying data is the same. But the second thing to say is they don't provide sufficient mechanization why one algorithm doesn't dominate and outcompete the rest. Like if one algorithm clearly provides its users more profit, why would there be any competition? I just don't see how they've effectively mechanized that claim. But the other observation I will make, as you've heard our case, it's just this would only possibly respond to an argument about market volatility, but it certainly does not respond to an argument about the allocative efficiency, because this is about the fundamental property of analyzing market data rather than the goodness of the product of a company and its financial viability, which that does not respond to. So if you think that deletes our case, I think again. The second observation that I'll make is that this now affects how individuals compete with one another. So if the PM is like, oh, this allows you to compete now with big companies, it seems pretty zero-sum now that if it's proliferated and everyone is using similar algorithms, I don't see how you gain a benefit. I don't see how that like gives people a leg up. I think that is pretty unclear to me. Let's deal with our case then. First, why this reduces the allocative efficiency of the market massively. And this requires you to understand what the fundamental purpose of a secondary market is, which is to allocate capital to businesses. When you set the price of a share by trading on it, you raise capital for that company because it's able to gain money from the shares that you sell, which means that we should, and the market ought to, reward companies that produce the most utility for the people who own those stocks and for society. It is good that it does that because shareholders, the main benefit of owning a stock is that you gain dividends in the long term when that business gains profit. So it's good to allocate capital to businesses that are likely to be able in the long term to generate those profits for shareholders. But additionally, it's good for society that we reward businesses that do have good products that are financially viable in the long term and are likely to advance human society in meaningful ways. That is meritorious. That is a good thing. Why is the case the current status quo allocation of how we decide the efficiency in the market is preferable? Of course, we acknowledge there is some data analytics that occurs in the market, but humans, as opposed to AI algorithms, are tremendously inefficient at this because they cannot process market data at the level that is required to kind of make the predictions that would be competitive here. It is statistically very difficult to do so. Without it proliferating, it would be expensive, and very few people would utilize it. Instead, what happens in the status quo and would continue to happen is that traders, when they decide whether or not to invest in capital into a company by purchasing their share, would research that company. They do things like looking into their revenue sheets, their balance sheets. They consider whether that product is genuinely something that has worth. They do significant research into whether that product is likely to be competitive into the long term and have worth for society as to be a reliable investment to increase own value over time. But what happens now is algorithms are trained to analyze market data and make predictions about how human traders, or even now AI traders, are trading and decide which stocks are preferable, which means that it no longer makes those kinds of predictions. And we would know this becomes very irrational over time, especially given the context of proliferation, because now AI algorithms are simply predicting how AI algorithms are likely to behave, which means it essentially becomes a circular cycle of predicting its own behavior, which becomes increasingly divorced from product value, increasingly divorced from the financial viability of the product that business offers. And note this escalates over time as AI algorithms become faster and better and more proliferated and more used by broader sectors of people who trade on the stock market, which only compounds that allocative efficiency harm. The harm of this is actually enormous. It means that companies that are productive, that produce valuable products, that pay dividends effectively to their shareholders are less likely to succeed because now you're not strongly selecting for those companies with the efficiency of the market. But secondly, you are willingness to invest in companies to publicly trade your company becomes far less, because now it is no longer true that having a product that is extremely good means you are likely to be successful on the stock market. Now, your success on the stock market as a publicly listed company is significantly dependent on gaming an AI algorithm that has significant risks for you for selling things that eventually lose lots of value. That means that the willingness to invest in big companies that have a lot of value that may be risky but have good products decreases. That is bad. It also is good because people who own stocks ought to have dividends from that long-term profit and long-term viability of that company. They have a decreased ability to access that in the world in which those companies no longer have the ability to actually pay the profit to their shareholders because their share price has been inflated by an AI algorithm that's only predicting how AI algorithms behave. I'll take the POI from CG.
So maybe I'm seriously misunderstanding the emotion, but surely on both sides, good products and good companies will have their products be bought by the consumer that will in turn raise its stock value. So then the AI will then just recommend gooder stocks or gooder products anyways.
This is about how you get capital from the secondary market by selling your stocks and raising revenue, which means that when you have an AI algorithm that is only predicting how AI algorithms or human traders are behaving, rather than looking into the revenue sheets, rather than predicting that company's long-term profit and viability, it means that secondary stock and that value of that secondary stock is not determined by the product value. It's no longer determined by the long-term viability of that company. It is now determined by the behavior of the market, which is far more irrational. This also increases the volatility of the market because it creates trading of much higher frequency, because the trends of the market are constantly changing on a nanosecond to nanosecond basis. And AI becomes much better at predicting these kinds of things, and therefore it becomes very volatile, the prices of stocks, because they change every couple of seconds in response to most users on the stock market using an AI algorithm. The response is that stock values become incredibly volatile. And this is bad, I think, honestly, because many people are reliant on the value of their stocks remaining relatively stable. They invest in low risk things like superannuation and rely on that for when they retire, or retail investors who do rely on this to get income when they are leading towards retirement. Those people have less willingness to invest. They lose a lot of money, and they lose value of the money they've invested in stocks pretty fast and pretty irrationally. And I think that is just bad. But it also decreases trust in the market overall and investment in those secondary market and those companies overall, which is bad for the value of the capital that companies are able to access, and it's also bad for the stock market itself. Charlie will extend upon this at DLO. For that reason, I am proud to oppose.
Excellent. Thanks, DPM.
Hi, give me a second, please. Okay. PIs in the chat, please. Let me reassure CG, they haven't misread the motion. I think OO has. As per the info slide, these models are trained to identify trends and patterns in the market. This is currently what a broker does to provide for trading. This is currently what a broker does. This means that a lot of what these AI trading models will be doing are what a broker would do, but instead of having it do it for JP Morgan, they will be doing it for anyone who has access to this, which will be everyone, as per Dragos's model that probably and all the other platforms are likely to want to develop this. I think they're going to do very similar things to what brokers are doing, but crucially more safely, with more information and more democratically accessible. And I think it completely missed the crack of our case. I also want to point out shockingly little interaction with it. First thing they point out is, there won't be more models. I think the implicit premise here is, maybe you'll have a bad robot. I don't think this is true. Dragos already dealt with this. Obviously, at first, you might have different AI models. They will, self-select. And at the end, you might have like 2 or 3 good and developed AI models. They might merge as well. This just goes to prove that you are likely to have, reliable and good AI models, because this is how the market works. The second point they say is that the market ought to produce more social utility and good products. This is the implicit premise here being that humans do that and the AI won't do. That's funny and very untrue. One, what do big funds invest in? Derivative instruments, zero social value. They just create money out of contracts. Apple, zero social value. They just create a smaller iPad every day. WeWork crashed massively, zero social value. Airbnb fucked up the real estate market and people's properties, zero social values. So their premise that humans invest in, social utility and always predict good products is inherently flawed. The reason why that's true is because people make a fuck ton of mistakes as per Dragos 4 mechanisms or why humans fail. They note panel, they apply to normal people, but they also apply to brokers, because brokers also work within networks. If a broker or a massive broker panics, other brokers panic as well. If the brokers from JP Morgan panic, the other brokers panic as well. If a huge investor pulls out, the other brokers panic as well. This is crucial because it proves that it is inherent into human nature to have some faults in assessing information or some asymmetry of information. The AI structurally does not have this. So it is a better model to defer to, even if you don't buy any of the democratization stuff. Secondly, they say the problem is you can't train it to take into account different elements and blah, blah. Although, of course, you can. A lot of elements can be mathematically quantifiable, and you can make the AI look for those when they assess a firm. Like you can have it have criteria that fit your portfolio. You can make it look for stock price, for customer satisfaction, to how much the business has increased in the past 4 years, make an assessment based on this, and then trade stocks on those results. So you can modify it again, because this is something that we do to brokers as well. So the main pushback from MOP of, it will only account for stock price, I think is very reductive. Lastly, they say, I think CEO says this is about massive giants because individuals don't have money to train them. Dragos already explained why there will be incentive schemes for Revolut to train the AIs. But secondly, I'm also okay if big firms use it as well, but the effect there is more marginal. That's why our case focuses on democratization. Secondly, as I've explained before, our max apply on why people are shit and they apply for brokers as well. Last point on all that I want to take down. They will start analyzing themselves, and it will be like a very weird loop of feedback. Again, AI models analyze each other AI models all the time in computer science. They're accurate into doing that. They're more predictable than humans because they're mathematical and there are smaller margins of errors. Also, not exclusive. Brokers also analyze themselves. Lastly, CEO, I went through that. I'm going to scale the impacts, but before that, I am happy to take CEO.
Yeah, even if your case is 100% correct, why is it the case that there's still not a very massive asymmetry? Like, why is the deduction in this asymmetry so important when like the show still has the best AI?
Because an average Joe doesn't have 10 years of experience that the broker has, but the AI has the computational capacity, has the access to all of the information, and can process 10 years of information of the broker in 2 hours, right? You equalize this because by default, AIs can learn more than an average Joe can understand or comprise. No responses. I want to build up and scale the impacts. What does irrationality lead to? People are scared and they pull out a lot because they're fearful of losing money. This means that a lot of time brokers from Wall Street and stuff like that take advantage of this. This is why banks or like big portfolio firms always fall on their feet as opposed to people who always lose their money, because brokers can manipulate the fear that they know the population will have, can somehow last a bit longer in the market and always end up on the winning side. This disappears when you equalize the market, when you have the information asymmetry decreases. I'm going to scale your impact, so our impact, so they can't undertake them. One, worst case scenario, even if you don't buy anything else, people have a marginal better management of their tiny portfolio, which means that instead of losing $1,000, they gain them, which can they use to massively increase their life, buy stuff, send their kid to university. Secondly, they don't flock to risky ventures until they've been vetted properly, or at least have feasibility proofs mathematically that support them, which means less risk management. So even if there is no gain, this AI isolates them against massive risk, which is something a human would intuitively prioritize, and you should as well. What are the broader scale impacts here of democratization? You don't resort to finance brought on you. There's a diversification of the kinds of businesses that they're likely to invest in, because if it becomes more safe, more normal people can use the stock market to direct their passive income, which means that the portfolio firms won't direct all of the businesses to the stock buyers, to Apple and to WeWork, but to smaller businesses, because a person is likely to not be dissuaded by the AI to invest into a startup. You should weigh this heaviest. One, because even a marginal increase in safety and skill is most relevant because usual people don't have savings to dig into, and the number of people will increase. So having a systemic tool where that gets better over time is crucial. I don't care of proofs, some risk, long-term needs to be implemented to get better. OG.
Thank you, DLO.
All right, hello.
Three things in the speech: defending our case, then responding directly to opening government, and thirdly, explaining a new piece of standard on how this creates more market manipulation. Firstly, then, defending our case. The first thing I'll respond to is a POI we hear from closing government, which says, on both sides, surely there are better products that still earn higher share prices. The problem with this is kind of true in the status quo, where trades based on market data only reflect the underlying value of those companies to the extent that the market data which those data analysts are analyzing is done by human traders who are analyzing the underlying value of that company, which means as these AIs get more and more proliferated and a higher and higher percentage of that market data of those buys and sells and all of those trades comes from other AI algorithms, which are also purely engaging in analysis of this type of market data, you get further and further abstracted away from the underlying value of that corporation. So even if it's true that in the status quo, people who analyze on market data don't currently ruin the stock market, it becomes true as these AI algorithms get proliferated. And this is necessary for all of opening government and the government bench as a whole to have any impacts in this debate, for this AI to get meaningfully proliferated to large numbers of people, which means as more and more people are trading on market data, the more and more abstracted you get landing all the impacts that Oscar explains to you. But secondly, we explain that this impacts over time, because as more and more trades are made based on market data, the more accurate market data becomes at predicting future trades and future stock prices, which means it gets done more and more, which mechanizes why we think over time, a high percentage of these trades are done purely based on market data, rather than the underlying value of that company, creating the allocative inefficiency that Oscar expands. Next, they tell you that, well, maybe the artificial intelligence will also read things like balance sheets, also read the news, also try to interpolate the underlying value of this company. But the first and clearest problem with this is that if you believe our mechanisms to explain why when AI algorithms do this analysis of market data, and if you believe the thing that opening government tells us themselves, which is that firstly, lots of trading companies right now attempt to do this, but secondly, that AI algorithms are very good at predicting what each other do. If you believe that this is a successful trading strategy, which in time becomes more and more effective, it's totally unclear why they would bother engaging in that underlying analysis, because as we explained to you, the vast majority of the harms that accrue as a consequence of engaging in this kind of trading come to society, as businesses are less willing to invest, people are less willing to start companies because they don't have faith in the fact that the market will efficiently allocate capital towards them if they actually engage in good business practices. If it is true that this is successful, it is totally unclear why opening government's narrative exists and these AI algorithms will trade from this stuff too. But secondly, I think there are a larger set of incentives which exist to trade on this data. That is, when you attempt to interpolate things like balance sheets or read the news or engage in that form of an analysis, that takes far more time because you're attempting to predict long-term trades. And the consequence of that is that you're unable to trade at the same level of frequency that you can if you're purely interpreting market data. And that higher frequency trading returns higher rewards because you're able to analyze more pieces of data, engage in those changes more consistently, and earn more money over time. And the consequence of that is you are able to earn more money by analyzing market data, which you can do much faster, engage in higher frequency trading. What that explains to you is, firstly, it's very unlikely that any incentive would exist to do things like analyze balance sheets using this AI. But secondly, even if that incentive did exist, it would be outweighed by the counter incentive, which is to engage in high frequency trading based on market data in the first place. That knocks out that response to our extension. Next thing they say is human traders right now don't trade very well on the value of companies, so this harm already exists in the status quo. The first problem with this is that it is untrue. The largest trading institutions in the world, investor funds like Berkshire Hathaway, as well as large pension funds, engage in this exact form of trading. They invest in long-term stocks based on their predictions of the value of those companies. But secondly, it's unclear this can even be done right now. If you do an economics degree or know anything about economics, you know the question of whether or not humans are capable, without insane intelligence like artificial intelligence, can be capable of accurately predicting future trades based on market data isn't a solved question, which explains why large hedge funds often do lose money and are hesitant to invest large amounts of money in quants and expensive mathematicians. But thirdly, this is expensive and extremely hard. You have to hire incredibly intelligent people and invest huge amounts of faith in them, which means not all traders on the market are currently doing this. What's left of our case then? Firstly, we explained to you this creates a huge amount of allocative inefficiency, which Oscar already impacts. It means companies are less willing to start up, people are less willing to invest in business because they're worried that an AI algorithm will arbitrarily decide that their stock price should go down, even though they've been doing the best they can. The less you can predict markets as a company, the less you're willing to start that company, even if investors are able to do that prediction. But secondly, Oscar explains to you this creates huge amounts of instability, because if you believe that these AI algorithms trend towards at least one algorithm, or even if you don't believe that people are all using the same algorithm, which obviously they would, because why wouldn't you just use the best one? At least these AI algorithms are all operating on the same data set, which means even if you have many algorithms, they're all making similar trades. And the consequence of that is when there are inefficiencies in the market, or the market undervalues a stock, there is a huge overcorrection and you get a swing back in the other direction, which causes this large amount of instability. And the consequence of that instability is a lack of trust in the market. People become less willing to invest. People become less willing to engage in economically productive activity. I'll take a POI from closing government.
Yeah, so this is a debate about the rise of this technology. If your analysis is true, most of big companies probably already have an incentive to deploy this for profit maximizing incentives. Why does this not also signal distrust and make people not want to engage insofar as these big companies take up large parts of the market?
Proliferation of these technologies, we oppose it. We say a world in which it doesn't happen is better. That's how these motions work. You are supporting a thing that is actively causing harm, but in order for you to have any benefit, you have to believe this gets proliferated to a much larger extent than it currently is in the status quo, which means even if the harms also exist on our side, they exist to a much larger extent on your side. For you to have any comparative benefit, you also have to have the harms that we describe, which are worse. Finally then, responding to opening government. Their only real case here is to say that now more normal people can engage in trades. But firstly, why do people need to trade on individual stocks? Most people already have the capacity to do things like trade in baskets of stocks, things like the ISP 500, which are far more reliable, far less risky, and far more safe, and often lead to long-term profits. So why does the average person need to trade on individual stocks in the way that these larger hedge funds do? But secondly, I don't think this is a real harm, because to the extent that this is a minority of people who are retail investors and trade on individual stocks and don't do things like invest in the ISP 500, those people consent, and them losing money isn't a real harm. Finally then, let's explain why this creates more market manipulation. Obviously, incentive exists on both sides if you want to the market. But firstly, now there is more incentive than previously, and you need a high incentive so that people are scared, because people are scared of going to jail, because small manipulations in the market have a much bigger impacts than they previously did because of the mechanisms we explained before. But secondly, people have a larger capacity to manipulate the market. Firstly, because if you can understand how these algorithms work and the data they're being fed, you can more easily predict how you need to manipulate that market. But secondly, because you can be more certain about the success of your manipulation, you don't need to manipulate the market as much to gain a profit. This is firstly unfair because it screws over the people that lose money when you do these trades. But secondly, causes distrust in markets because there's no faith that that market isn't being manipulated, which means less investment and lower market liquidity, which is a harm. We clearly deliver the biggest impacts and win this debate.
Awesome. Thank you. Gov member.
Cool. Hopefully I'm audible and visible. I would like POIs in the chat, but if I don't take one by 5:30, please interrupt me verbally. Our extension from CG is very, very simple. The first thing I'm going to explain is why the proliferation uniquely allows you to identify problems in this type of model that ensures that you don't get the extent of volatility and problematic activity from bigger companies that cause the massive economic problems. The second thing I'm going to explain is why it is actually more likely that the way that these models are developed, and I think this is important because AI just doesn't magically appear on your computer and start doing trading. They're developed and coded by individuals who have particular intentions for what they want this AI to look like, the type of priorities they want it to consider, and the way that they want this AI to make evaluations of investment and risk aversion and all of these things. I think it is very, very likely that when more people are making these AIs, that there is going to be some individuals that code it in a way that is more willing to take certain risks towards investing in companies that are going to make good products and have large potential. So I don't think it's actually as exclusionary as OO frames, but I'm going to respond more and weigh internally. The first thing I want to talk about is I think proliferation uniquely allows for problems to be identified and remedied. Here's why this exists as a big problem right now. On both sides, the harms that OO talk about of making potentially poor decisions, of volatility still happen because the big companies that are using it will continue using it. The problem is what you have the difference is when we have proliferation of these models and more individuals testing out different types of models, you're able to find out what the problems with these models, the decision making, and all of these codings are in a much lower stakes environment. What do I mean by this? When it is only big companies that are kind of experimenting with these models, the risk or the harms that happen if there is a problem is much, much higher. The difference is when more companies are experimenting with these models, models, and it's not the big companies that have massive investments that have those large social and economic repercussions, you're able to identify those potential problems earlier in a much lower stakes environment so that it doesn't happen when those bigger companies are already using those models. And so in the instances where the model fucks up for those bigger companies, well, you actually just prevent instances where those model fuck up in those big ways for those bigger companies and don't cause those large economic harms. I think the second thing I want to talk about is you don't actively harm smaller companies or smaller institutions that are experimenting with these models as significantly. The reason this is the case is, even if it is true that when smaller companies or more companies experiment, you're able to identify problems, you can often identify these problems before large trades happen. What I mean by this is the Infoslide simply says that individuals do not have to intervene. It does not explain that you cannot intervene. What this means is when you recognize that the AI is behaving in a way that you do not want it to, or going through with a trade that you recognize is going to be negative, you can intervene and stop that trade from happening. The difference is you have more of those instances where you recognize that it has messed up in a particular way. And so you're able to remedy and change and alter the coding to ensure that that doesn't happen in more instances, especially when bigger companies that have larger harms are doing it. The second thing I want to talk about is I think this is specifically contingent on proliferation happening, because when more companies test these models in different ways, bigger companies don't have to be the guinea pigs upon which these problems are either found out or then remedied upon. So you don't actually get the large volatility and economic and social harms that OO kind of hinges their outcomes on. And I think this is important because the way machine learning works is you feed off of more and more data. So if more companies and more individuals use these codes or find out different ways to interpret and implement market trends, there's more information that allows for better standardization and efficiency in how these models are employed and how trading works using these models. The second thing I want to talk about is why this is actually better for smaller trading companies, but also for smaller businesses. I think the thing to realize here is smaller companies are, like OO says, the people that have the potential for new good products and probably are able to deliver dividends, etc., as per their own analysis. The problem is that OO assumes that these companies are actively being selected by traders within big companies right now. I don't think they actually provide you any analysis as to why that's likely to be the case. Here's the reason I think it is unlikely to be the case that is the status quo they get to defend and claim benefits from. The first reason is when individual financial analysts or traders are making these decisions, they probably have higher reasons to stick to the norm, to stick to companies that are more well-known, to stick to companies that have proven already that they're going to be really financially lucrative for them, because they don't want to be the individual financial analyst that is blamed. They don't want an individual person in their team that is blamed for making a poor decision. So they're more likely to default to the norm or default to things that they already know, which, as per their own analysis, is going to be companies that are larger and that aren't necessarily producing new products. I think the problem is that absent proliferation, you no longer have a willingness to take risks, because in order to protect their reputation, protect their jobs, things like that, individual traders are going to be more and more risk averse. I think the other thing that beats their framing or beats their argument is their argument is contingent on the idea that because AI can pick up small trends, the information it's going to be giving you based off of the volatility is going to be actively negative for smaller companies. I think the problem is the way decision-making for trading and buying stocks work isn't that you do it every day and what you decide to invest in changes between today and tomorrow. You probably make these decisions on a yearly or 6-month basis. And so the information that the AI uses about the smaller companies is also probably likely to be long-term. Before that opening.
Big trading institutions like Berkshire Hathaway aren't using AIs like this right now for all of their trades, only a small amount. By supporting the proliferation, you must support the proliferation to these big investors. Please defend your burden and also explain why big companies don't just do trial runs.
Okay, even if they're only using it for a small amount, the burden for them testing it out on that small amount is still really high. If they test it out on those small amount of trades and things don't go wrong and they start using it for more of their trades, which they're more likely to do because they're bigger companies, then all the harms I explained to you are still going to happen. The difference is if that testing out happens in smaller companies, you find those out before. See all my previous analysis. I think the last thing I want to talk about Actually, just to make sure I tie up the previous thing, it is untrue that the volatility impacts the ability to invest in smaller companies, because AI is better able to look at data from previous small companies that were able to be successful and apply why these new companies potentially are going to have the same trajectory. The difference is, if you're an individual analyst, you don't have, your brain does not remember information from 20 years ago and 30 years ago that data that the AI uses does. So you're less likely to have the capacity to make those decisions in the first place. The last thing is, you make it easier for smaller companies to access this type of financial analysis. If you make it more accessible, prices get lower. They currently don't have access to this analysis, so they lose out. For all those reasons, propose.
All right, thank you very much, op member.
Cool. Can you hear me?
Yeah.
3, 2, 1. 2 extensions from closing opposition. The first one will flip closing government. The second one will flip opening government. And I'm going to weigh over opening opposition on both of them. The first extension is just an explanation of what the comparative is, because I don't think anyone else points this out. It's not that models don't exist, guys. It's that high frequency trading exists symmetrically on either side of the house. And there are a few reasons for this. First, HFT is not dependent on artificial intelligence. It's often dependent on numbers and other types of things that are deterministic algorithms. So quants often don't work with things like machine learning. They often work with having things like numbers being input into deterministic algorithms. You sell over 50-day moving averages when it reaches over 200, or other types of complicated strategies. Notice that this is very likely adopted on either side of the house. And that's because this increases things like trading efficiency. It often means the increased automation on either side of the house on the comparative. What this does to closing government's case is that it marginalizes it to a really large extent on the comparative, because many of the regulations that they want can symmetrically be implemented on either side of the house. That is to say that if you want to regulate automation in terms of the market, that if you want to regulate how a model might make mistakes, this can be done symmetrically. Why then is AI worse than HFT on the comparative, which I think is a real question of this debate? There are 3 things to note here. The first is just the black box problem. And I want to be extremely clear. The problem with artificial intelligence, and CG tells you and OG tells you there is math behind this. I think there might be some degree of math, but it's very difficult to analyze billions of layers of nodes and understand exactly what is being processed through them. This means that it is almost impossible to come to an actual decision as to how the algorithm made a decision or how the AI analyzed the market. The problem then is twofold. Firstly, closing government's analysis on regulation cannot work, because you need to know what went wrong to fix it on the comparative. It's very hard to know what happened within the first place, which is why it's really problematic on their side of the house. Secondly, though, obviously it reduces things like investor confidence, and in many instances changes the perception of the market to be more volatile. And this is true at the point where you don't know how this is making these decisions on the comparative. The second claim under this is that it's really hard to regulate this kind of material on their side of the house. And the reason for this is quite simple. There is no degree of human oversight, so it's very easy to avoid accountability. This means big firms like B. Shaw, big firms like Morgan Stanley can be like, oops, our AI fucked up. Maybe it was some degree in the code. Where did it happen? And you often do not know about these types of things on the comparative. This allows them to often absolve responsibility on their side of the house. The comparative, though, is that the programmer often sets the parameters for a high-frequency trading algorithm. They're often linked and set at the level of the programmer and the coder within the first place. So it's often very easy to hold someone to account because you know the exact value on their side of the house. Finally, I just want to note that on our side of the house, you can often stop mistakes that happen. Closing government's claim is, guys, you can stop an AI trade before it happens. This doesn't bite their burden. An AI makes a decision and trades it automatically and near instantaneously. That's because it's likely the case that when you automate trading, you do it in the seconds of milliseconds on their side of the house. The comparative, though, is that because your algorithm is decided by a human, you often have significantly more checkbacks on our side of the house, and therefore you hold on the side of the house on our side. Finally, though, you're just likely to overfit on market data on their side of the house. Note that because you structurally cannot investigate all market data, and most of this is proprietary, there's a self-reinforcing cycle of bias. So it often looks like markets reinvesting into similar types of technology and often engaging in these types of things. The comparative, however, is that in many cases, younger people are more liberal in status quo, quant traders are looking for expanded business opportunities, etc. How do you weigh this against closing government? 3 ways. The first way is just to note that closing government doesn't actually prove how you get these regulations. Their only claim is, trust us, guys, we're going to be able to regulate. I think this is very unlikely, firstly, at the point where AI is not understood, at the point where AI isn't implemented in status quo. Secondly, it's very hard to hold them accountable. So the weighing becomes as follows. It's really easy to pass the blame on to others and pass the baton. What's the comparative where you actually have to be held to account on their side of the house? So you're likelier to get the regulations on our side of the house. But finally, even if their case is true, I don't think they actually prove the burden. They don't actually prove why companies have adopted AI in status quo. And the structural reason for why you don't adopt it on their side of the house is because obviously there is a perceptual barrier to adopting it. You really don't want to invest in the first new technology. You're also the large degree of cost associated with it. So the issue doesn't do this on their side of the house at the point where the others do not necessarily engage with this. So it's very unlikely that big companies adopt this unless there is a massive proliferation. Second extension, this is where I'm going to engage with opening government and flip them as well. I'm going to just fight the trade-off and say smaller investors in the market is actually really, really bad. And I'm going to explain why that's really, really harmful on their side of the house. But before I take down their claims and explain why this is bad, I'll take opening government on for opening government.
It's comparatively easier to protect against AI mistakes than human mistakes because AI leaves activity logs, traces, thorough records. People say we have decided. It's significantly harder. You compare.
When people say they've decided, you can call them out. The comparative is the AI log happened. Great. How do you prevent it from happening again? Where do you change the code? You don't know how the code works. You don't know if you can even hold them to account because who made the mistake in the first place? These are all very fundamental questions you need to answer. Anyway, second extension, why is it likely that you are likely to get significantly worse markets? The premise here is that trading is always a zero-sum game. If I make money, someone must lose money. And that's because the market always balances out. What does this then mean for debate? The first thing to note is that even if you're able to access AI, most people who are retail investors often don't have much information about the market. This is your average Joe like me and you who often don't know how to read graphs. They often don't know the degree and analysis of the market on their side of the house. And they often don't have much expertise. What this means is that on their side of the house, just because an AI can predict and give you a list of analysis doesn't mean they actually understand this or know the actual best stock to invest in. Secondly, though, there's just a market problem. Not the AI is recommending the same product to everyone. It's often recommending very similar products. So at the point where you invest in this way, it's unclear to me how the massive degree of profit happens. Why then is this likely to be risky and why is this really, really bad? The first thing to note is that the best AI always belongs to companies. And the structural reason for this is that they have significantly more market data than individual investors. So even if it's true that I can access AI, they show access AI times 1,000, and this often flips the degree on the comparative on their side of the house. Secondly, though, Revolut and other companies have incentives to make profit on their side of the house. This means AI is often gamified within their world. So Revolut doesn't give you their best AI. They often have premium subscriptions. They often have things like saying, we're going to make money of particular transactions. So their AI is often made to make you make things like risky investments because this is what they profit off of the most. This means the input screen will always show you the company that they really want you to invest in versus actually the best company on their side of the house. The result of this is threefold. Firstly, people make bad decisions because they think they know about the market. They actually do not. So when you do invest, you are likely to lose more money. Secondly, this is a larger population. Because no, they themselves tell you more people want to invest. So this is a much larger number of people who invest the same amount of money, but are now likelier to lose it. But thirdly, because you don't know about this, you often make more risky decisions. This makes the market overall more volatile on their side of the house. The weighing then is extremely clear. On our side, you can choose significantly more stable investments. I don't know why blue chip stocks and index funds don't exist. These are often more stable, often more reliable, and give you similar amounts of returns on our side of the house. I would rather someone's investment multiplies 1,000, 1,100, 1,200 rather than 1,000, 0 or 2,000 on their side of the house. Very proud to oppose.
Thank you, Gov. Web.
Can everyone hear me?
Yep.
Cool. I'll take OO. Give me a sec, sorry. Cool. All right, 3, 2, 1. Unlike usually, I'm going to speak very slowly and explain the exchange because I suspect you guys probably don't understand it, which is why Muzzy strawman rather than respond to it. So I want to assure the panel what our extension actually was. It was never just about regulations in and of itself. It was about why the proliferation of this technology creates a unique set of discussions and a unique set of behaviors that changes and makes it far easier for the processes in the market to be excelling. The first thing I want to point out here, and this is quite important in responding to closing opposition, is why it is likely that AI technology is currently used. And as a result of that, the comparative is not no technology versus a lot of technology. It is a lot of it on our side of the house and some degree of it on their side of the house. The first reason is because opening opposition concedes to this burden, which means if Muzzy wants to run the case they're running, this knifes opening opposition, and therefore by default, they're out of this debate. But second of all, listen to all of the analysis opening opposition themselves give, why oftentimes maximizes profit. The efficiency of it makes it quite good, but also uniquely for big companies. Oftentimes there's a massive ability for you to get rid of things, for example, like sunk costs. So even if the AI does fuck up, you still have a lot of other profit and revenue. That means you're able to cover it up, especially given the only one piece of analysis Muzzy gives is there's perceptual barriers. No one knows what's happening in the back door of these big companies. So there is no perceptual barriers because you cannot see. The reason why this therefore is important is because if it was the case that AI is quite bad, as closing opposition contends with in this debate, a degree of that still exists on their side of the house, which means a lot of the opening opposition harms and a lot of the closing opposition harms, although they exist to a less extent, still does exist. What then was the delta and the process we gave you an extension, which means we're able to get rid of this. And this also responds to the DLO response to my POI, because the comparative was not, we have a lot of harm, they have some harm. It was, we get rid of this harm, but they're never able to get rid of the harm. The first thing I want to do is respond to opening opposition under this. The first thing they say here was that individual investors are far better than the AI, and as a result of that, they get better market behavior. I just don't think this is true for the analysis Keerthana already gives. But even if it is likely the case that for some reason, these individual investors are quite woke, sexy, creative individuals, our argument was very simple. The process of the proliferation is not someone shits it out of the air and now it exists as AI. It is people talk about what the code ought be, how you ought to prioritize specific things that exist in the market and deprioritize other things, which means if opening opposition is correct, that individual investors are good, those bright genius minds are going to be the ones that actually program this AI on our side of the house, which means we're able to co-opt a large degree of the incentive analysis they give. There are 4 things, therefore, I want to flag out under this. The first is, what is unique on our side of the house that they do not get is the degree of discussion and safeguarding that exists. And this was the regulation stuff that Muzzy strawman. It was not that the government will regulate, but rather there are going to be checks and balances that only exist on our side of the house, which matters because listen to opening opposition. If the AI fucks up, there's bad things that are going to happen. If there's exogenous shocks, there are bad things that are going to happen, which means in the unlikely event in which it does, there's massive harm that exists on opposition side, even if it is not proliferated. At least on our side of the house, the awareness and discussion minimizes that potential risk and allows for more points of safeguarding that exist, which also deals with the top half analysis on risk. But second of all, and this is quite important, our argument was also that it allows for you to then to more cognizantly pick out specific things that exist with SMEs and smaller companies, and therefore integrate it to make it far more comprehensive, which is to say the overall net quality of the AI becomes far better because you include different checks and balances and different points of analysis that you always neglect on the side of opposition because it only belongs to big companies that have a very particular way of seeing the world, which by the way mechanizes the opening government analysis because OG just says Revolut has good incentive to do this. Yes, but don't explain what that looks like. We explain the process by which that happens and why therefore you get to the end outcome opening government wants to talk about. But third thing to note under here, and this is quite important, the bulk of the opening opposition push is that over time the AI takes over, and as a result of that, if the initial point of the AI is bad, you get bad investment down the line. We already proved why this was unlikely because the individual investor that is good on opening opposition can be the one that programmed this AI on our side. But importantly, recognize that there's a lot of other factors independent of the AI that exist in market data, which is the Infoslide, right? When I buy cookies, that affects market data and stock share of specific companies. It is independent of whether or not individual executives make decision A or decision B, which means that will still affect market data on both sides of the house. And AI is able to then use that to inference and figure out which companies are innovating, which means a lot of good products and good consumers will still get rewarded, which deals with the principle of opening opposition. But finally, and this is very, very important because this is the silver bullet we gave you that was not responded to by OpBench. Our argument was when everyone has access to this, you change the incentive in planning the AI, which is important because right now, big companies, for the reason that they have a shit ton of money and an asymmetry of power, as Muzzy points out to opening government in 2 POIs, are able to fuck with society. This is why things like recessions existed. This is why in vast majority of cases, big companies are the driver of bad economic collapses because they don't give a shit and they're able to do so, which is uniquely proliferated by the fact that you're able to do massive amounts of transactions, all of these sorts of times. The reason why we change this uniquely is because we change the incentive of these individuals when they're programming that AI, which is to say, when everyone is using this data because it is frequently and widely acceptable and available to everyone, you can no longer now have a really aggressive AI that tries to always take market share or always prioritize your own growth, because you realize that if that is the AI you set out and someone else adopts that AI, your company gotta get fucked in the ass, which means as a result of that, you preemptively change the incentive of the individuals talking about the creation of the AI to make it so that the AI is going to be more moderate. It is going to be more respectable. It is going to be more risk averse in the way in which they interact with the market, which minimizes crashes, which mechanizes the impacting and weighing that DPM tries to do. This was the extension that was important. And the reason why we're the only ones that get it is because we open up the market and make it so you're involving everyone. You never do that on the opposition side. Charlie, I'll take you.
Big investors also don't want recessions because it means they get heavily regulated and cracked down on them. But your other extension also doesn't make sense, because if it's so risky for big investors to use one AI, they would just use many different AIs, each managing a small portion of their total portfolio to hedge that risk, which achieves the same benefit as that extension.
Yeah, no, so the issue is, even if they use many different AIs, they can still be extremely aggressive. Yeah, maybe it's not the case that all big companies are always going to try to go for recession, which, by the way, I think is empirically untrue. Look at how most big companies drive society to collapse. But our argument was on scale, right? You're more likely to get more risky behavior that causes recession for poor individuals who have no alternatives, as you claim. So on a sliding scale, more economic risk on your side. We're able to mitigate it for it on our side, because when everyone is involved, there's checks and balances that exist. Finally, then, let me weigh against the long cost and explain why they're not that important in this round. For the same reason Muzamil gives in the second extension, this is the reason why OG and CO are probably out of this debate. Because for the most vulnerable individuals, I don't think this policy is a tipping point. Either you can go on eToro or look at YouTube tutorials anyways, and the most vulnerable people are still going to use that as a mechanism of investment independent of AIs, or they're going to try to invest even if this AI doesn't exist. Like if I'm really, really poor and I really need money, the tipping point is not AI. The tipping point is I see someone, I give them money because I want that return, which means the inherency of that argument from long cross to this debate is minimal, whereas our argument on how the technology and the AI changes individuals is probably substantial. For all those reasons, Anna, don't do this. Closing government wins this debate.
Thank you. Upweb.
Cool. Just need to turn the cow filter off. Okay, great. Starting in 3, 2, 1. I agree with CG. Me, as an individual consumer who wants financial literacy, can just invest in the S&P 500. That's not the argument we're making. We're saying when you change the incentives of individual consumers to invest in these high-risk AI models, as opposed to the stable index funds that provide 10% returns annually, that is independently bad. 2 points of framing that Muzzy gave you that goes unresponded to. The first is CG also strawmans our case. What we're saying is automation and data analytics and machine learning already exists, which is what our OO said. What we're saying the margin of difference is that firms do not use the automated aspect of it, and why that automation is specifically bad in comparison to the algorithms that already exist for the average consumer and company. The second point of framing, which I think takes out a lot of CG as well, is that there's more than one AI model. Like even now, Gen AI has multiple different companies competing. That is, your company is not going to get fucked in the ass because each company is going to develop their own proprietary information. It's unlikely that the convergence of information is going to cause regulation because there's no one centralized model that all consumers and all companies are going to be able to use. It is probably the case that D. Shaw will still make a very high risk, volatile model that they're going to leverage, and it's going to be independent from whatever Revolut is putting out. Then I think no team in this debate has specifically clarified why there is a need for the average consumer to be able to access these very fast, high-speed trades. Let's talk about what hedge funds and quant firms do right now, right? The only reason they're able to make a massive amount of profit is for 3 reasons. The first, as we tell you, is because you're able to make pooled investment with liquid assets by doing very high-risk strategies like short trades, derivatives, and leverages. That is the reason why most of their consumers are institutional investors, hedge funds, or pensions, or very high net worth individuals. Is the only people who have the capital to be able to make these risks are really rich people. This is not applicable to the average consumer. The second is because the capital transaction costs are incredibly high due to the volume of trades that they're making. That is, if I'm losing a percentage of my money on every single trade, the only way that I can get a return on investment is if I have a lot of money, and if I can do this at a massive scale. And third, we would just say that the average consumer probably can't deal with this level of liquidity. That is, when I want to be able to ensure that I can draw my money to be able to pay my rent, I don't think I'm going to want to do it on a microtransaction scale where one day I might lose a lot of my money and one day I'm not. Secondarily, then, I think we can symmetricize a lot of the case about why the average consumer should access this by just saying that the average consumer should probably prioritize things like investing in the S&P 500 or investing in their 401k or Roth IRA with any index fund that can provide consistent returns. The implication is that the alternative does not exist for people to need to be financially prudent because these people are not the ones who are competing with the kinds of returns that hedge funds are likely going to be made. But what is the independent offense that we get from this? We can concede both gov teams push that we are going to change consumers' incentives to want to use these strategies. Why? First, we think this is just a large trend that we would say is already existing. Like Muzzy told you, people don't have the correct perception of what these things are because of the black box. That is the same reason why people invested in in GameStop and Dogecoin, even though these were volatile investment, is because this looks like something flashy. People like Gen AI. Second, Muzzy tells you there's likely incentives to advertise this and to market this as a good strategy. But we would say it's incredibly bad to distort consumer incentives for a few reasons. The first is just that the level of bankruptcy that you can incur, the degree of risk you can incur is probably really bad. The second thing that we would say is that you have a less degree of protection from the market. That the regulations that exist on both sides of the house probably apply symmetrically, right? CG says we get more regulations, but most consumer regulations that can be implemented, like not making incredibly risky trades, not collapsing the market, exist. But we would say that these regulations can be enforced more rigorously when you don't have automated trades, when the rapidity of these trades is a lot slower than if these rapidity is a lot faster. That's where the delta in this debate lies. Now let's talk about each team individually. What does OO tell you? OO tells you that, what does OO tell you? I think it's unlikely that the volatility matters that much in the status quo because the investors want it. I think the differentiation is not on whether the market is volatile, but it's the amount of people you translate into each kind of investment. That is, if there exists long and short investments, it's likely the case that Goldman Sachs still invests 20% of, still buys 20% of share of a company because they want to see that company actualize in the long term. PE firms still buy up small companies because they want that company to succeed and they want to sell those dividends. I think where this debate lies is on those short-term trades, which in the past already existed. So I don't think it's about changing the types of investments you're making. What I do think this debate is about is changing the balance of consumer allocations between these two forms of investments. That is, one form is always going to be volatile. It's always going to be based on market behavior and not the success of the company. But when we incentivize more people to think this is the better investment, that's where the margin in the debate lies. I'll take a point from CG before I get into them.
Exactly, because there is such a risk within AI. Only when all members in the market then realize this risk will you do something to modify the algorithm or make it so that it doesn't fuck up the economy. That never happens on your side, which means there's still massive risk.
I don't think the issue is the awareness of the risk, right? I think it's the inability for you to regulate this AI. That is, when we get to CG, it is unclear why the majority of things that should be regulated are not already are. That is, you cannot regulate the individual incentives or behaviors of AI. When you increase the frequency of trade, the frequency of volatility also increases. So any marginal increase in regulation is likely outweighed by every trade. That is the same reason why, for instance, in 2014 to 2015, the microtransactions that AIs made in 3 seconds lost billions and billions of dollars in investments due to the collapse of the market. I think it's not the case that the government wouldn't regulate these things if they could. It's the fact that when you make these high frequency microtransactions, these are unable to be regulated. Because no, even if you pause every once in a minute to check if the AI works or not, this still doesn't counter the fundamental mechanism, which is that this is an automated model. Like, don't let them run to the middle and say that this is not automated. The second thing then is I think that this doesn't change the planning incentives or asymmetry of power. And I think this is where we can respond to both CG and OG. That is, there still is an asymmetry of power regardless of what happens for all of the reasons I told you. First, the capital cost. Second, the speed of the market. Third, your ability to hedge bets. That is, even when ChatGPT is still available to the majority of the market because they want to train on human data, there are still premium versions that are vastly superior and vastly better. And in the instance of financial markets, will be able to like create a far higher return on investment than a lot of the existing consumer models. That means then all of the asymmetry of power that both OG and CG rely on to talk about why you change the planning of incentives of companies is unlikely to have any margin of difference, given the fact that you're not going to make your models open source, right? You're probably not going to release the most premium version out there. It's unclear, and they don't ever fulfill the burden of why you would have a profit incentive to do so. Because we want to protect individual consumers, we are very proud to oppose.
All right, that's the debate, everybody. Thank you very, very much. We're gonna deliberate now. So yeah, thanks.
Good round, guys.
Thank
Thank you for judging.
Thank you.
Congrats.